Gold is sitting at $4,834. Silver has surged to $80.87, and equities just rallied 1 to 2% in a single day, all while oil is still hovering around $90. That combination doesn't normally happen, but right now it is. So the real question is, what is the market actually pricing? Welcome to the 2% Brief. If you want to stay ahead of the curve, hit like, subscribe, and share this with someone who needs clarity in these markets. And for the deeper breakdown, head over to our Substack. That's where we go beyond the surface. Now this week, markets didn't just move. They reacted to a very specific shift in expectations around both geopolitics and macroeconomics. The reopening narrative around the Strait of Hormuz has clearly influenced sentiment, but the market reaction hasn't been clean or one-directional. Instead, we've seen multiple asset classes move higher at the same time, which tells you this is more complex than a simple risk-on move. Let's start with the metals, because this is where the signal is strongest. Gold is up 1.75% on the week at $4,834. Silver is up a substantial 6.2% at $80.87. And platinum is up 2.8% at $2,111. Now, what stands out immediately is not just that they're rising, it's the pace of silver relative to gold. A 6% weekly move at these levels is significant. We said previously, particularly in the Inner Circle briefing, that if tensions eased and energy flows normalized, we could see the war premium come out of precious metals. That would typically mean gold softening first, with silver then potentially recovering later on due to industrial demand. But the market hasn't followed that script. Instead, what we're seeing is a layering effect. The war premium hasn't fully come out. It's become sticky. Even with more positive headlines, markets are not fully pricing resolution. That keeps a floor under gold at $4,800. At the same time, silver is not waiting. At $80.87, it's already pricing the next phase. Improved industrial activity, better manufacturing outlook, and potentially lower input costs if energy stabilizes. So you've effectively got gold pricing uncertainty and silver pricing recovery at the same time. That's not normal, but it is very informative. Now bring in the dollar. The dollar index has eased to 98.09. It's not collapsing, but it's clearly softer, and that matters. A move from above 100 down into the high 90s is enough to loosen financial conditions globally. It supports commodities, supports equities, and gives breathing room to emerging markets. So part of this metal strength is not just geopolitics. It's also currency-driven. Now let's layer in oil, because this is where expectations are being tested in real time. Brent is just above $90, and WTI is just under $84. Earlier in the conflict, we saw spikes well above these levels, and even a temporary inversion where WTI traded above Brent. That has now normalized, but prices are still elevated relative to pre-conflict levels. And here's the key point. If the Strait of Hormuz situation was fully resolved in the market's eyes, you would expect oil to be materially lower than $90 by now. The fact it isn't tells you that traders are still building in a buffer, a risk premium that hasn't fully gone away. This creates an interesting feedback loop. Elevated oil keeps inflation expectations alive, but any move lower from here would quickly improve cost structures across industries, especially mining and manufacturing. Watch out for those silver miners. That's another reason silver is outperforming. The market is anticipating that shift before it fully shows up in the data. Now let's talk equities, because this is where sentiment has clearly shifted. The Nasdaq at 24,468, S&P 500 at 7,126, Dow at 49,447, and FTSE 100 at 10,667. These are not cautious levels. And when you add in 1 to 2% gains in a single session, Friday, that tells you buyers stepped in aggressively. So this looks like a combination of short covering and fresh positioning. Investors were defensively positioned during the height of geopolitical tension are now being forced back into the market as worst-case scenarios are priced out, at least partially. But here's the nuance. Equities are rallying alongside gold, not instead of it. That tells you investors are still hedging. They're participating in the upside, but they're not fully convinced the risk is gone. That's a very different type of rally compared to a clean risk-on environment. Now, the macro data this week supported that move. Core PPI dropped sharply from 0.5% to 0.2%, which is a meaningful cooling in producer-level inflation. Import prices edged down from 0.9% to 0.8%, reinforcing that trend. And initial jobless claims fell from 218,000 to 207,000, showing that the labour market is still holding up. Those three numbers together are important. They suggest inflation pressure is easing without a breakdown in employment, which is exactly the kind of backdrop equity markets want to see. However, the drop in the NFIB Optimism Index reminds us that small businesses are starting to feel strain. And that's often an early signal, not a lagging one. So again, you've got this split picture. Strong markets, improving inflation data, but underlying economic pressure building in certain areas. When you step back and look at all the numbers together, dollar at 98.09, oil around 90, gold at 4,834, and silver at $80.87, and equities pushing higher, this is a market in transition. It's not fully pricing risk off, and it's not fully pricing risk on. It's pricing a middle ground where inflation is cooling, growth is slowing but not collapsing, and geopolitical risk is reduced but not eliminated. That's why correlations look unusual right now. And this is where positioning becomes critical, because in transition phases, markets can move sharply in either direction, depending on what gets confirmed next. If there's one thing to watch next week, it's the dollar at 98.09. That continues to drift lower. It acts as fuel for both equities and commodities. But if it stabilizes and starts to push back towards 100, that tightens conditions quickly and could pressure both. Now, beyond that, there are several additional things we're watching closely, which we'll break down in the Inner Circle deep dive on Substack on Sunday evening. We're watching, for example, whether silver can hold above $80, or if that move becomes overstretched in the short term, whether gold can sustain above 4,800 without fresh geopolitical escalation, and whether oil breaks decisively below $90 or finds support and turns higher again, and also how bond yields respond to this mix of cooling inflation and resilient growth. We're also watching equity breadth, whether this rally is broadening out or being driven by a narrower group of stocks, because that will tell us how sustainable this move really is. Now, if you found this useful, hit like, subscribe, and share it with someone who's trying to make sense of these markets. And if you want the deeper edge, not just what's happening, but how to position, head over to Substack and join the Inner Circle. Thank you for watching. Also view the videos on screen now, and we'll see you in the next 2% Brief.